Right now, global trade is slamming into a massive multi-front supply shock. The immediate trigger is a critical bottleneck at the Strait of Hormuz. Ever since the late February geopolitical strikes, passage through this absolute main artery for global energy exports has essentially ground to a dead halt.
20 million. That is exactly how many barrels of oil are being disrupted every single day by the Hormuz blockade. The physical impact we are seeing here is truly unprecedented. It's effectively removing 20% of the world's traded oil from standard routes, and that is accelerating the depletion of global inventories by a staggering 4 million barrels a day.
Maritime throughput is facing a severe contraction. Just look at the drop. Supertanker traffic plummeted from 22 vessels down to a mere 4 in just one 24-hour period. That is an immediate volume contraction of over 80%, and we are watching commercial circulation freeze in real time.
And this disruption extends way beyond just crude oil. It's triggering a cascading supply chain freeze across liquefied natural gas, methanol, and sulfur. Major shipping giants are being forced to reroute all the way around the Cape of Good Hope. That adds 7,000 kilometers to their voyages, which is severely depleting global vessel capacity. Before we move further into the data, please note that the information presented in this explainer is for educational and informational purposes only. It absolutely does not constitute financial, investment, or legal advice. Past performance is not indicative of future results. All strategic allocations and market assessments involve risk, so you should always consult with a certified financial professional before making any investment decisions.
Section 1. Monetary constraint and trade fragmentation. Western central banks currently find themselves trapped in a highly restrictive posture. They are practically forced to maintain high interest rates just to combat tariff-induced price pressures and escalating energy costs, which are actively being passed right through to consumers. This policy divergence has actually fractured internal consensus at the Federal Reserve. They are facing a fundamental stagflationary challenge, weighing the risk of a structural labor market breakdown against supply-driven inflation that just stubbornly refuses to drop to target levels. This brings the effective federal funds rate to 3.64%. That single metric establishes the baseline for our restrictive monetary environment. We're navigating a very complex landscape right now, where prolonged monetary over-tightening is severely straining both corporate and sovereign debt structures. The Fed is actively trying to suppress domestic demand to match this newly constrained global supply. But if these high rates trigger a systemic credit event, unexpected liquidity crunches could materialize rapidly in overnight funding markets, forcing an aggressive unwinding of this entire restrictive framework.
Now, the Federal Reserve's rigid upper limit target range sits exactly at 3.75%. This aggressive posturing is happening against the backdrop of a low-hire, low-fire labor market equilibrium. Layoffs might remain historically low, but wage growth is definitely softening. Policymakers are utilizing this balance sheet restraint and restrictive rate policy to intentionally curb economic growth. However, this is a blunt instrument approach, and it carries a massive risk of overcorrection. If monetary policy stays this restrictive for too long, it is inevitably going to choke off economic output and lead to structural job losses.
Looking ahead at the 2026 FOMC meeting schedule, there is a primary volatility catalyst staring right at us: the May expiration of the Fed chair's term. If we see a major organizational change at the Federal Reserve this May, institutional investors absolutely must brace for interim bond market volatility. A new chair would introduce a massive layer of uncertainty regarding the trajectory of rate cuts for the remainder of 2026, which would force a complete top-to-bottom recalibration of fixed income strategies and yield curve positioning.
Compounding all of this monetary strain is severe systemic trade fragmentation. Following the Supreme Court's dismantling of IEEPA tariffs, we are now looking at a flat 10% rate imposed across all nations as an interim measure. Add to that the impending renegotiations of the United States-Mexico-Canada agreement coming up this summer. These specific policy actions are violently pulling global trade in competing directions. Countries that previously negotiated favorable bilateral deals are losing their edge. That guarantees fresh volatility in equity markets and is going to drastically accelerate the localization of critical supply chains.
Section 2. The structural offset, the AI Capex boom.
While the broader global economy is getting battered by these severe macroeconomic headwinds, specific growth sectors are entirely decoupling from this reality. This decoupling is driven by a truly unprecedented expansion in technology capital expenditure, specifically the rapid acceleration of global artificial intelligence infrastructure. NVIDIA just posted a record $81.6 billion Q1 fiscal year 27 revenue. That shattered Wall Street consensus, fueled by a massive 92% year-over-year surge in data center revenue alone. This exceptional growth links directly back to the severe capacity bottlenecks we've been analyzing. It confirms that the AI infrastructure build-out is accelerating at an extraordinary pace. The transition from Hopper to Blackwell architecture is driving sustained, heavy capital investment. It proves this is not just a one-off upgrade cycle, it is a continuous architectural roadmap demanding massive capital deployment.
To ensure you stay ahead of these rapid institutional shifts, hit that subscribe button for @NextGen Invest Global. We deliver continuous, data-driven macroeconomic and strategic portfolio analysis, translating these incredibly complex data prints into actionable intelligence for your institutional allocations.
We are currently looking at dual-speed economic drivers defining 2026. On one side, we have a $680 billion tech AI Capex cycle led by the major technology firms. On the exact opposite side, a $680 billion total global oil and gas Capex. 7 technology companies are now spending exactly as much on AI infrastructure as the entire global energy industry spends to find, produce, transport, and refine the physical commodities that power the whole global economy. These dual massive capital injections are the primary structural forces currently offsetting global stagflation.
Now, a critical dynamic to watch here is exactly how the technology sector is adapting to current geopolitical realities. Strict U.S. export controls legally mandate zero data center compute revenue from China for advanced architectures. However, sovereign AI infrastructure initiatives are successfully neutralizing this mandate. Nation-states all across Europe, the Middle East, and Asia are executing highly localized, state-backed infrastructure buildouts exceeding $30 billion. This secures their own technological autonomy and ensures that the broader technology capex cycle remains highly insulated against any specific regional trade restrictions or bilateral tariff escalations.
Section 3. Strategic Portfolio Solutions. Translating the convergence of these macroeconomic supply shocks and structural tech cycles into specific, actionable equity positioning is absolutely essential for the remainder of the year. Based on the structural supply deficit and current capacity bottlenecks, offshore drilling contractors like Valaris and Transocean provide direct leverage to the multi-year deepwater capex cycle. With monetary policy rigidly tight, targeting the belly of the yield curve offers optimally managed interest rate risk. Furthermore, the recently enacted Genius Act establishes a regulatory framework that structurally boosts demand for safe-haven U.S. Treasuries through stablecoin collateralization. Finally, the elevated and persistent geopolitical risk profiles strongly support sustained, long-term allocations in defense prime contractors, specifically those laser-focused on autonomous systems and aerospace defense.
These structural shifts require continuous tactical adjustment and rigorous data analysis. Click the Macroeconomic Explainer playlist on your screen right now for our next deep dive into 2026 market dynamics. Keep your strategic allocations optimally positioned for this incredibly complex environment, and we will see you in the next analysis.